In this video, we're going to take a look at a handful of high-yielding dividend investments that I think the market has recently been treating unfairly. The reason these stocks have dipped in share price is because they've reported something in their latest earnings that spooked the market just a bit. But I believe the concerns aren't great enough to justify the falling share prices that we've seen from them, let alone considering selling shares of these stocks. This means that, in my opinion, they're now currently trading at more appealing valuations. And some of these investments will have different strategies than others, so do your research to make sure that each stock aligns with whatever your investing strategy is. So with that being said, let's go ahead and get started. The first stock that I think the market's been too pessimistic towards recently is Capital Southwest, ticker CSWC. They're an internally managed, credit-focused business development company actively providing flexible capital solutions to lower middle-market companies across the capital structure. They primarily back private equity firms that generally fit within their own parameters, which include flexible financing solutions to fund growth, changes of control, or other corporate events. The investments Capital Southwest makes are typically between $5 and $50 million and are usually floating rate first lien debt. In addition, they also regularly make equity co-investments alongside their debt investments. I know this first stock is likely going to be a controversial pick as something that's undervalued, because by all the typical BDC metrics that are normally used to evaluate these companies, this stock isn't undervalued right now. But CSWC, I believe, can't be valued like most other BDCs that exist. I consider them to be in a somewhat similar category to Main Street Capital in that they've been able to provide better growth than what we typically see from these kind of investments. Capital Southwest has fallen more than 15% in share price since July, despite recently reporting near-record net interest income for them. Because of their stock's recent sell-off, it now offers a yield of over 11.5%, which is higher than average for the BDC sector right now. And in their most recent quarter, their dividend was 113% covered. This caused them to issue a special dividend in addition to their regular quarterly distribution. But it's also important to understand the history of this company. They're the oldest publicly traded BDC in the sector, having been a BDC since 1988. Over the years, this company has gone through some pretty serious changes. In 2015, they transformed their business in order to pursue more income-focused investments. They spun off most of their existing investments into a new company called CSW Industrials, which were mostly equity investments that weren't offering high yields. Despite its 11.5% dividend yield and good dividend coverage, Capital Southwest isn't without its risks. In their most recent quarter, they reported an uptick in their non-accruals, which are investments that they've made that they aren't earning interest on. That's my biggest concern with this company right now, and it's likely the reason for its share price drop. But just like I mentioned earlier, their earnings are still near their all-time highs. I did buy a small number of additional shares of CSWC not too long ago, and I will likely buy a little more soon. But as of right now, from a share price perspective, I do think CSWC is a little more appealing. Switching gears now to a different kind of dividend investment, the next stock we're going to take a look at is Triple N REIT, ticker NNN. Originally owned by the American restaurant chain Golden Corral as a way to allow their employees to invest in the company, the REIT broke off in 1994 and became its own independent company. As of their most recent quarter, Triple N has 3,549 properties in their portfolio, with a lot of automotive service centers and convenience stores. For 35 years and counting, this REIT has been able to provide yearly dividend increases, making them a dividend aristocrat. I can't deny that this is a bit of a boring company compared to Capital Southwest. It doesn't offer nearly as high of a dividend yield, but it does offer some very appealing things to dividend investors. First, it currently offers a yield much higher than typical of an equity REIT at over 5.5%. Second, their dividend provides a combination of safety and growth. Their AFFO dividend payout ratio as of Q3 of this year was just 67%. That's extremely conservative. These companies usually like to aim for 70 to 80% AFFO payout ratios. So then why is their stock so undervalued? On their latest earnings call, it was announced that a handful of their tenants were experiencing financial issues, specifically Big Lots, Conn's, and Frisch's. All three of these companies have recently filed for bankruptcy, or they appear to be heading in that direction. That news appears to be what's recently been sending their stock falling. I do believe the markets have been overreacting to this news for a few reasons. First, Triple N's occupancy rating as of October is still extremely high at 99.3%. That's higher than their long-term average of 98.2% and much higher than the REIT average of just 90.5%. Second, Triple N said that they anticipate Big Lots being able to stay in all of their retail locations. And third, again, their payout ratio is very conservative. We will have to keep a close eye on this stock to see if things get any worse, but I still think the market has been too pessimistic with this stock for a while. It could be that it is a slower grower compared to other REIT options that exist, but it's still a solid holding with dividend increases. It's a good holding if you're more risk-averse and you want more consistent dividend growth. But another stock that the market still isn't treating well despite excellent results is Blue Owl Capital Corporation, ticker OBDC. Blue Owl Capital describes themselves as a specialty finance and business development company that provides direct lending solutions to U.S. middle-market companies. Their portfolio consists of predominantly senior secured loans that are directly originated by Blue Owl Credit's team of investment professionals. The company also makes investments in unsecured loans, subordinated loans, or mezzanine loans, and also considers equity-related securities. Starting in early June of this year, their stock started falling and ultimately dipping by more than 15%. Today, OBDC offers a yield exceeding 11% and incredible dividend coverage of 127% as of their last quarter. The stock has become one of my top 5 holdings in my dividend portfolio, and I've been really impressed with its performance up to this point. They're currently in the process of merging with another BDC that was also owned by Blue Owl Capital, and once they do that, then I think it's going to look even more appealing. From what I gathered, there's a couple reasons why this sell-off occurred back in June. First was, at the time, this BDC was using a lot more leverage than they are today. Anytime that a company uses leverage, this can make an investment much riskier, and it was possible that this did play a role in the sell-off that we saw back in June. Another issue is that this company hasn't been as active when it comes to making new investments compared to their peers. They had several quarters where they had negative net funding. That means that they were exiting investments, but they weren't replacing them with anything new. This is obviously going to be required if you want to build up your investment portfolio. But Blue Owl Capital appears to be improving. They've since lowered the amount of leverage that they use, and they appear to be making more investments. Their non-accruals have also dropped down to just 0.7% of their portfolio. This is one of the lowest in the sector, just right behind another really good BDC, which is Blackstone Secured Lending Fund. OBDC has been recovering over the past month, but it's still offering an attractive dividend yield of over 11%. They also have a much higher than average insider ownership percentage, indicating that board members are pretty optimistic about their future, since they are buying shares with their own personal wealth. And that's going to wrap up our look at some stocks that have dipped in share price that I think are more appealing. In our current market environment, where it's a common belief that most stocks right now are overvalued, finding better deals is one of the better ways you can increase your chances as an investor. But let me know your thoughts on these positions and if you're buying any of them or if you already own any of them. With that being said, that's going to conclude today's video. Thank you all so much for watching. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.